Jeff, a lot of talk about how some of the biggest outperformers over the last 12 months, some of the smaller cap tech names, the ARC universe, as some people call it, have started to pull back significantly. But what about the big cap tech names, the FANG names, and companies of great size that aren't that expensive on a PE basis? Is there any of the charts of those stocks that look a little bit more concerning?
You know, I would say Amazon is the one that seems to be the big laggard, but that's not a big surprise to us given, you know, where it was a year ago and sort of the savior, the retail savior, if you will, with home delivery and everything else. But when we go through and look at the Facebooks and the Googles of the world, those are still really good uptrends. You know, look, they're not high beta tech names, so they're going to underperform as you get this sort of shift that's happening. But I think the absolute trends in those names are still intact and still look good. I just think on a relative basis, you're going to have to sort of sit on your hands and wait for those to come back into favor. So, you know, it depends on a lot of things, tax gains, et cetera, what you have in those names. But I do think you have a period of underperformance, but not a big period of vulnerability as we look at those names.
There's been some questions, Jeff, and I know you continue to like cyclicals. I think you mentioned consumer discretionary, about whether the money chasing some of those groups has been as speculative as some of the money that's chased the high growth names in this liquidity-filled environment. Do you think that that's true?
You know, it's a great question. I don't think, from what we're seeing, not so much. I mean, one of the ways that we measure that is high-priced versus low-price performance. And we're not seeing an outsized representation of low-priced names. So there's, I think at the margin, maybe there's some, but there's not enough for us to make some big call that says, hey, there's too much fast, hot money chasing this, and therefore it's really, really dangerous. In fact, you know, one of the charts that we were going to show, we just didn't have time for, was there's 93% of the S&P 500 constituents are above their own 200-day moving average. Now, people might call that overbought, but if you look at the stats of that going back to 1926, when you get that number above 91%, it's a pretty good number for forward return. So I think there's enthusiasm in the market. I think people are certainly, you know, performance chasing to a degree, but it hasn't got to the point, in our view, with the work that we do, that suggests it's yet at a dangerous level.
Shepard Smith here. Thanks for watching CNBC on YouTube.